down 41% in 2022. Is Uber stock a buy for 2023? I'm going to answer that question in this video, so stay tuned. The first thing I'm going to look at is Uber's revenue growth quarterly going back before 2019. And what you can see here is explosive revenue growth for Uber, especially after 2021. Of course, the company has two segments, right? It has its rides section, its rides business, and then it has Uber Eats, the food delivery business. That side of the business exploded during the pandemic when dining inside restaurants was prohibited and folks started ordering food for delivery a lot more often. So it's got 8.4 billion in revenue in its most recent quarter. Excellent revenue growth. So now let's see if it's making any money off of those revenues, and it does not look like that's the case. Uber is actually losing a lot of money on the bottom line, 495 million in its most recent quarter, and I only see moderate increases in losses. So its losses are improving, but ever so modestly as it's growing its revenue. At least it's not like some other companies that are growing this fast, where the faster they're growing revenue, the faster they're losing money on the bottom line. That's not the case for Uber. What you see is flat and slightly rising operating income, so lower losses on the bottom line. So it's improving in that regard. Next thing I want to look at is cash flow from operations. Sometimes companies can be losing money on the bottom line in terms of net profits and operating income, but then they're also making money in terms of cash flow from operations. This difference arises because tech companies like to pay a lot of stock-based compensation, which is a non-cash expense, and that allows them to generate cash flow while losing money on the bottom line in terms of net profitability, because stock-based compensation, they have to account for that on the income statement. Even though it's a non-cash expense for it, they're not doling out cash, they're doling out stock options and stock grants, and so they're able to generate cash in that regard. And so what we see is a nice upward trending cash flow from operations from Uber. They at the worst, they lost over $1.6 billion in cash during right at the onset of the pandemic. And then we see very nice growth and positive cash flow from operations in several of its more recent quarters. So that's a good sign that it's starting to increase cash flow from operations, even though it's losing money on the bottom line. And it's in a difficult business. It's got a very high degree of variable costs, so that each incremental customer it serves, it costs Uber a great percentage of its cash flow, great percentage of its expenses are variable. So that's not generally um, good news in terms of achieving economies in scale, because as you grow, your expenses grows along with your revenue growth, so you're not leveraging your fixed costs, you're just you're expanding your costs as you grow. But at least Uber has managed to show that it can increase its cash flow from operations as it's increasing its revenue. All right, finally, let's look at Uber's valuation. And I looked at two different metrics. I looked at its price to free cash flow, and I looked at its price to sales. Looking at its price to free cash flow, it's trading at a price to free cash flow of 106.79. It's on the higher end of its range. We don't have a long history for Uber's price to free cash flow because it's only recently become positive in terms of free cash flow. But even in that brief history, it's trading at near its most expensive in according to this metric. However, if you look at the price to sales ratio, we have a little bit more data on this, even though still not very long data, just going back to 2000, a little before 2020, and we see a price to sales ratio of 1.86. It's near the lowest it has been going back all of this time. So a mixed mixed picture in terms of valuation. You have one metric telling us the stock is extremely expensive. We have another metric showing the stock being relatively inexpensive. And I would tend to favor the free cash flow metric rather than the sales metric, because companies can always make sales if they're willing to lose money on the bottom line, right? I could create a product that costs me $5 and sell it to you for $1, and I can generate a lot of sales, but I'm going to be losing a lot of money on the bottom line. So, in terms of informational value, I tend to value the price to free cash flow, price to earnings greater than a price to sales ratio. So in that regard, I'm going to weigh this more than the price to sales ratio. And for my recommendation, I'm going to say Uber stock is not a buy for 2023. Okay, so that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.